The Office for National Statistics said that GDP contracted by 0.1% during the quarter, a downward revision from its previous estimate, which had been for growth of 0.2%. The services sector, the largest part of the economy, did the damage. The ONS said it contracted by 0.2% during the quarter, offsetting growth of 0.4% in construction and growth of 0.1% in production, which includes manufacturing. The technical definition of a recession is 2 consecutive quarters of contracting GDP. The ONS revealed last week that the economy contracted by 0.3% in October. Well, joining me now is Simon French, Managing Director, Chief Economist and Head of Research at Panmure Gordon. Simon, I have to tell the viewers, you told me last week you thought there was a downward revision in the offing. What made you think that?
Well, there's a couple of things. First of all, the first release, which we got about 6 weeks ago, was right on the knife edge of being negative. So it didn't take much in the data, in the new data that the ONS would get over that 6-week period to trigger a downgrade. But also some of the data, particularly at the back end of the summer, September, had been a bit soft, and that data had come to light. So while I don't pretend to sort of know the vagaries of the sort of calculations, the way ONS go about it, I thought the risk-reward suggested a downgrade may be possible.
Is this the final cut on these numbers, or is there another potential revision?
Well, there's one more further revision specific to Q3, but actually, if you look at the history of GDP, it gets revised often years afterwards. So the full economic history of this period will actually only get written 2025, 2026. But I think what we can do, and sometimes for viewers, there's such a blizzard of numbers, it's difficult to step back and say, what does it tell you? I think it tells you that the economy, while it hasn't hit a technical recession yet, it's right on a knife edge, and we've had really no growth for about 12 months now. Absolutely.
And obviously, we had a contraction of 0.3% in October. I mean, the economy is going to have to go some in November and this month to avoid a technical recession.
It is, and in your introduction, you did point out of quite constructive retail sales numbers, up 1.3% in November. We had overnight data from car production in the UK, which will help the production numbers, which have been quite soft. And also we've seen ticks up in both the services PMI and also consumer confidence in November. So what I think is when we get that monthly data in November, we'll see something of a reversal, which will probably even itself out. And then December's key. And of course, we're still in December. So that key trading period, particularly for retailers, but also the degree to which economic momentum, confidence can push the economy, avoiding a negative number, it's going to be right on a knife edge.
It is. I mean, I know it's rear-view mirror stuff now, but in Q3, I was quite surprised to see production notching up growth during the month, because the PMIs around that period weren't particularly encouraging.
Yeah, and it does, I think, question whether those PMIs can be a really strong read. So while we've seen strength in services and weakness in manufacturing, it isn't necessarily coming through in the quarterly data. But actually, one of the things that was behind this big revision as well was the cost of doing business was quite a bit higher. The GDP deflator, the amount of inflation in the economy, the margins, that was pressing down what real terms growth we were having. And I think because we've seen some better data on inflation, most recently on the consumer prices measure, that should help GDP going into 2024, trying to look through the front of the car rather than just simply through the rear view mirror.
Absolutely. We'll stay with us, Simon, because you referenced the retail sales figures there, and we can mention these now. Separately, the ONS did report a strong rebound in retail sales for November. It said retail sales volumes rose during the month by 1.3%. That was considerably better than the 0.4% that had been expected in the city. The ONS also revised the October figure. Previously, it had estimated that retail sales volumes fell by 0.3% during the month, and today it said they were flat. I mean, Simon, these are really quite surprisingly good numbers.
They are. It does indicate perhaps, I mean, always with retail sales data, I think I've said this to you before, it's better to look at what the Met Office are saying than necessarily what high street retailers are saying. And of course, October was quite a warm month, and therefore actually some of the winter lines were being delayed in terms of the purchases. So that some of that went into November, so that explains perhaps that differential. But also we saw evidence of a more savvy consumer who was waiting for some of the discounts available around Black Friday. So there's always a bit of uncertain seasonality around the data. But you're right, what we've seen value growth, but volume declines, a bit of a jaws emerge on retail sales. Just a sense that that's starting to come back together.
Yeah, I mean, we've had the CEOs of both Currys and Boots on the programme in recent days, and they both said they had an excellent Black Friday. It looks to have really done the business this year.
It is, and it's encouraging that consumers have got, not all consumers, but there's still consumers with decent balance sheets. That means they've used the pandemic sometimes to pay down a bit of debt, and they're starting to be a bit more confident on taking on some more debt. It's very cautious stuff. These are not numbers to get particularly excited about, but if we're looking to January, when the retailers report from the first week in January, next will obviously be the first one out of the traps, I think there's some sense that the festive trading period has been better than some had feared.
Well, we hope so, certainly. Simon, well done again on getting it right, and have a happy Christmas. Thank you.
You too.
Bit of breaking news to bring you during the last few minutes. Regulated rail fares in England will increase by nearly 5% from March next year. The Department of Transport has set a cap of 4.9% for increases to most fares regulated by the government, which includes season tickets on most commuter journeys, some off-peak return tickets on long-distance routes and flexible tickets for travel around major cities. Labour have responded, they say it is a brutal rise. Some other business news stories for you now. And HSBC's proposed sale of its business in Canada has come a step closer after the Canadian government approved the deal. HSBC has agreed to sell the business for 13.5 billion Canadian dollars, that's £8 billion, to Royal Bank of Canada. The deal brings together the largest and 7th largest lenders in Canada. The government has made the sale conditional on RBC setting up a global banking hub in Vancouver, protecting HSBC's Canadian workforce and allowing HSBC customers to switch their mortgages to RBC without incurring any fees. RBC must also keep open at least 33 branches, provide a minimum 7 billion Canadian dollars of financing for housing construction and raise staffing levels at an operations centre in Winnipeg by 10%. The fintech company Revolut has gone into the red despite recording record sales. Publishing its delayed accounts for 2022, Revolut reported revenues of £923 million. That was up 45% on 2021. But a pre-tax loss of £25.4 million compared with a profit of £40 million in 2021, when earnings were boosted by a large rise in cryptocurrency trading by customers. Revolut also saw a large increase in costs after more than doubling its workforce during 2022 by hiring more than 3,000 new employees. And Unilever has agreed to buy the premium haircare brand K18 for an undisclosed sum. K18, which was only founded 3 years ago, has a range of 6 products which aim to help identify and address the causes of hair damage. Unilever, whose existing hair care brands include Tresemme, said K18 is a fast-growing brand that sits at the intersection of beauty and biotechnology. It said the brand had been a pioneer of using social media to educate and engage consumers about the science of hair. Now, the last few weeks have seen a pickup in housing activity, according to Zoopla. The property portal said today that the final 3 weeks of 2023 had recorded above-average levels of new sales, with a 17% increase compared with the same time last year. Zoopla also said that demand was some 19% higher than it was this time last year, when higher GDP contracted by mortgage rates hit activity. And it said that house prices appear to be declining more slowly. November saw average prices fall by just 1.1%, compared with 7% in November last year. Well, joining me now is Richard Donnell, Executive Director of Research at Zoopla. Richard, welcome to you. Are you surprised by this apparent pickup in activity?
Well, I think we've got to put it in context with a year ago. We had the post-mini budget fallout. But I think actually when you compare to 2019, which is before the pandemic really got going, sales are higher than then. So there's clearly improvement in market sentiment. People can see that the mortgage rate cycle has maybe peaked, and it's bringing a few people back into the market who've been delaying move decisions.
Yeah, you mentioned that there's been an increase in supply. What do you think has caused that?
Well, supply is just back up to normal levels. It's up by nearly a quarter. So there's been a huge pickup in supply. That shows there's people in the market wanting to sell property. As we covered last month, they're taking a much bigger discount to the asking price to agree a sale. But it's positive that buyers and sellers are in broad alignment. And I don't think this signals a big rebound in house prices. But I think it shows that the big price falls that were forecast are not really needed to get the market back in alignment.
Yeah, I mean, that's a really interesting point. Why haven't house prices fallen this year? If we cast our mind back 12 months ago, everyone was saying, oh, the market's going to come off quite sharply. It hasn't happened. Why not?
I think it's because of mortgage regulations that were brought in 2015, specifically designed to stop a big house price bubble of people taking unsustainable levels of debt. So mortgage rates went up. It created an overvaluation of housing on paper. And that overvaluation is really just unwinding now through much lower house price falls, rising incomes doing a lot of the hard work, basically. But mortgage regulation was the big reason.
Yeah, I guess in nominal terms, prices haven't fallen. In real terms, I guess they have because of the levels of inflation we've seen elsewhere.
Absolutely. And I think, particularly in markets like central London, where the average value of a house today in nominal terms is the same as it was 7 years ago. So, the real falls have been much bigger.
Absolutely. Now, something that we've talked about in the recent past has been the rise of the cash buyer. I mean, your research out today suggested a third of transactions this year down to cash buyers.
Yeah, cash buyers are normally about 1 in 4 purchases, but I think we've seen the big drop-off in mortgage transactions because people are sitting on the sidelines, either can't afford to buy or waiting till they think that mortgage rates are going to flatten out and or fall. So yeah, this year mortgage transactions down by about 30% or so. So cash buyers about flat in actual number terms, but their share has gone up. And look, 55% of homeowners don't have a mortgage, so even at a third of transactions, they're sort of below their weight of the market.
Now that's the here and now. What are you expecting next year?
I think it's all about mortgage rates, and whether we're assuming at the end of next year mortgage rates are going to be 4.5%. Depends on the general election and the timing of that. But I think house prices are still going to be going sideways to downwards slightly, -2 next year. Transactions 1 million like this year, but with some upside for both of those two. If, and that's the big debate within financial markets, if and when mortgage rates start to fall.
I mean, we're likely to get a general election next year. Typically, do elections affect housing activity?
They do around activity levels more than prices. So people do tend to put off decisions for 4 to 6 weeks before an election, depending when it's called. And again, I think if we had an early one in the spring, then it would probably have a drag on transactions. If it was right at the end of the year, then it would probably have a limited impact on the overall outcome in 24.
OK, Richard, got to leave it there. Happy Christmas to you. Hopefully see you again in 2024. Thank you. Well, the pound is a little firmer this morning. The markets largely overlooked the revision to Q3 GDP data and focused more on the stronger than expected retail sales figures. Pound up 0.2% against the dollar right now, up by nearly 0.25% against the euro. The single currency, meanwhile, up 0.6% against the greenback. On the equity markets, well, another strong session on Wall Street last night was followed by a largely downbeat session in the Asia-Pacific region. Both Hong Kong and Shanghai finished lower. That was after China unexpectedly unveiled new rules aimed at restricting the amount of time people play video games. In Europe, here's the current picture. Most of the markets in positive territory right now. The DAX more or less at break-even. Talking points this morning include the Italian appliances maker DeLonghi, which is up 2.25% in Milan. That's after it bought a 41% stake in the high-end espresso machine maker La Marzocco. Here in London, FTSE 100 is going into the weekend, long Christmas weekend, slightly higher right now. Remains on course for a 4th consecutive weekly gain. Energy and financial stocks lending support right now. Not many individual stories around. The largest percentage gainer right now is Lloyds Banking Group, which is ahead by just over 1.5%. The biggest percentage faller this morning is JD Sports. That's off nearly 5%, and that is on the back of a downbeat trading update last night from Nike, which sent its shares down 10% in after-hours trading. Outside the FTSE 100, well, if you were watching our 4:30 show yesterday, you'll have seen me mention Harbour Energy. It announced a blockbuster acquisition yesterday. The shares are up a further 5% on that news. It's a truncated trading session today, I should say, by the way. Trading on the London Stock Exchange stops at 12:30 today, just under 3/4 of an hour from now. As for the oil price, well, it looks set to notch up a 2nd consecutive weekly gain, having fallen for the previous 7 before that. Barrel of Brent crude currently changing hands at $80.03 a barrel, up 0.4%. Well, joining me this morning is Sophie Lund-Yates, lead equity analyst, of course, at Hargreaves Lansdown. Sophie, good to see you this morning. Not too many stories around, but HSBC caught your eye.
Hi, good morning. Yes, we're in that season now where we start to get information a little bit thinner on the ground in the corporate sense. But this Sale of HSBC's Canadian business isn't new news in itself, but the approval for the deal to go ahead from Canada is. And the reason that this is significant, really, HSBC, obviously one of the UK's biggest listed companies, and we know that they're undergoing quite a significant portfolio reshuffle. And what this latest stage in this sale tells us is that they are really ploughing ahead with this. Because they want to be able to refocus, re-energize, and look at more exciting growth areas, particularly in Asian markets. So this deal is worth about $10 billion US. Some of that's coming back to shareholders in the form of special dividends, but it does free up a lot of capital for them to reposition themselves and look more closely at the Asian businesses.
Yeah, very interesting move. Now, another one that caught your eye was Carnival. Obviously, it's listed in both London and the US. They've just had results out.
They did indeed. So yesterday afternoon, our time, and the reason Carnival is so important to look at is because it's a really important kind of consumer barometer. It's a cruising giant, and the shares have risen both yesterday and in today's session, up about 6%. And that's off the back of some really quite impressive numbers. Revenue was up over 40%. Forward bookings for next year look pretty strong. So technically, the picture is a pretty one, but the number that we cannot ignore is the net debt figure. That is still a big problem. It's standing at about $28 billion. That is just phenomenally huge, both in comparison to earnings and actually the value of the company itself. So as much as free cash flow generation is going to start looking hopefully a little bit better, it's going to take a long time before that debt level is at a place that is close to being comfortable.
It sure will. It's been knocking on the door of the FTSE 100 for a while, Carnival. It was, of course, originally in there. It's one of the most highly valued mid-cap stocks, I think, out there, isn't it?
It is. It's certainly been on quite the journey, and it was really, really severely punished over COVID. Of course, owning and operating cruise ships is one of the most capital-intensive businesses out there. So when everything was shut down, the financial scarring was very significant. But they are doing everything they can, and operationally they are in a much better place. So who knows what might happen? But as I say, unfortunately, when you strip it back to those fundamentals, there's still a great deal of work to do. Unfortunately.
Yeah, absolutely. Now, what about the retail sales figures? Certainly the FX market has homed in more on that today than they have the GDP figures.
Yeah, they have indeed. I think they're taking good news where they can find it. And I know you were talking about this earlier. But the reason for me that this uptick in retail sales, it is good news. Volumes are moving in the right direction. It's showing that a consumer that is more resilient. The problem is that, again, as you were alluding to, a lot of this top line movement is coming from increased discounting. So getting tills ringing at any cost is not the way to go for long-term financial resilience. A lot of the big physical retailers are already sitting on operating margins that are in low single digits, sometimes 1% to 2%. That is not enough breathing room. So as much as we will take the momentum where we can find it, and it's good to see consumers proving quite resilient, the margin outlook for next year, particularly as I think we are going to see quite a significant pullback in consumer spending in Q1 next year, that for me is really going to need monitoring.
Yeah, wise words. Sophie, we have to leave it there. Thank you for all your contributions this year. It's been lovely having you on. Hope to see you again in the new year. In the meantime, happy Christmas.
Happy Christmas. Thank you.
Well, still to come here on Business Live, the French startup that's created a device that can detect bacteria in food and drink in real time. Don't go away.
A new year, bringing with it new hope.
This is incredible.
That's what I like about it.
Give us a song then, Rod.
Good news, it's not extinct.
To start planting a whole new rainforest.
It's really heartwarming to help others.
India, the first to land south of the moon.
The lonelier sheep has been rescued.
Love it, did amazing.
Best story of the day.
It's saying I've got a Sky News break on my own phone.
News never stops.
I'm Inzamam Rashid and I'm Sky's North of England correspondent, telling stories from this culturally rich region I call home.
It's going to become very similar to other places and lose its unique qualities.
It's steeped in history.
If the Taliban found your family, what would happen?
I think they're just going to straight away execute them.
There are issues of racism in all levels of cricket.
I was on the balcony a couple of times. I was nearly gone.
Football is a joy to watch, and when people are disappointed, you can feel the hate.
I just felt physically sick because I was like, that's really in my system.
We take you to the heart of the stories that shape our world. Even before the pandemic, GPs were pleading for help. Government expects more face-to-face contact with patients in return.
Men, they want to force you doing something which you don't want to do, just because you're homeless and you're looking for a warm place to sleep.
We give a voice to communities often unheard and unserved from a region with a distinct history and global impact.
Welcome back. Now, if producers of food, drink and other fast-moving consumer goods suspect there may be pathogens in their factories, they must wait up to 20 days for samples to be tested in a laboratory. But the French startup Spore.bio claims to have created a device that can detect bacteria in food, drink, pharmaceuticals and cosmetic products on a real-time basis. It's just raised €8 million in a funding round from investors, including Famille C, the investment company founded by the family which owns the Clarins Cosmetics brand. Well, joining me now is Amin Raji, the founder and chief executive of Spore.bio. Amin, welcome to you. How are you able to do this sampling and testing so much more rapidly than at present?
Good morning, Ian. Thanks for having me. Basically, we have built a new technology that, at the opposite than conventional techniques that use biological innovations to detect bacteria, we use a physical innovation, and we basically train an algorithm using machine learning models that can spot the spectral signature of bacteria. So that's how we managed to do it, by having large data sets of lots of products, contaminated and non-contaminated, to be able to recognize the presence of bacteria.
And how quickly do you expect to be able to launch this product commercially?
Basically, we are already working with food and beverage, pharma and cosmetic manufacturers, as you've mentioned, to have the first products in beta testing in 2024. And we're going to launch our first commercial product around 2025.
And will you be tying up exclusively with particular FMCG companies, or will you have a general sort of launch across the market?
At the moment, we're working only with some of them that have dedicated microbiology R&D teams that we're really building the technology with. But obviously, starting 2025, when we'll have our first commercial product, we'd be working with lots of manufacturers all around the world that have critical products that requires a lot of microbiological testing.
Is contamination becoming more of an issue in the FMCG industry?
Sure, because of climate change and the rise of antibiotic resistance, we're seeing those issues happening more and more in the industry. I'm sure you heard recently quite a lot of food recalls that has happened over the last few months or few years. And that's why our solution came at the right time to really help manufacturers prevent those catastrophes.
So it's not necessarily that standards have become higher in industries, it's the fact that there are more sources of contamination.
It depends on the market dynamics. The first reason is true, the rise of the risk of contamination, but we're also seeing a trend in emerging countries, for example, where the standards are getting a bit higher and they need to do a bit more of testing compared to the more developed countries.
What are the biggest sources of food poisoning in food production?
It depends. The main ones can come from raw materials that are organic, natural elements that can contain bacteria, or it can be the contamination directly at the factory level because of water or basically handling of the material that can contaminate. And the pathogens that you can find in these environments are the ones that you hear a lot, like E. coli, Salmonella, Listeria, depending on the type of product that you're producing.
Are there certain types of bacteria that are harder to identify than others?
Sure. At the moment, there is one that manufacturers talk a lot of. It's E. coli stec, which is a serotype of E. coli that is particularly dangerous at the moment, and that is really hard to spot. And that's one of the one we're actually working on at the moment.
And I think I'm right in saying you are a medical doctor originally. How did you come about launching this product? Was it something that you were specifically looking to address and tackle?
I was, a manufacturer. I spent the last years working at Nestlé in food and beverage plants, and I met one of my co-founder, Maxime Mistreta, who is a PhD and postdoc from Institut Pasteur, and he has been working on this microbiological technology, and that's basically how we came with the solution.
And I mean, very impressive that you've come up with this product. Have you had any sort of help from the French government or the Moroccan government, indeed?
Sure. The French government, we're working with BPI, which is the French national bank that is supporting us since the beginning of the project and allowing us to really develop our R&D and deploy our first prototypes in 2024.
Very good. I mean, lovely to talk to you this morning. Best of luck with the product, and thanks for joining me.
Thank you so much, Ian. Thank you for having me.
That's it from me, and indeed for Business Live for the rest of this year. We're back on January the 2nd. I will be popping up next week, though. If you're watching Sky News, do stay tuned for that. In the meantime, a very Merry Christmas from me and all the Business Live team. Up next, it's Sam Washington. Don't go away.